can talk about whatever I want to talk about. But um, we're mostly focused on some economic issues, financial issues. It's not a financial planning show, so I'm not going to tell you how to get rich. I can't figure out how to do it for myself, so certainly I can't help you. But um, I can hopefully offer you some information that would be useful when you're looking at some of the things that you might be facing here in Stewart or in Martin County or even nationally or internationally. So hopefully it'll provide you with some information that you can use and hopefully also be somewhat entertaining. My name is Mark Breckbill. I'm a CPA, so right away that kind of goes against the entertaining concept, right? I mean, but I am a CPA and ex banker, so I've spent a lot of time in the financial world, which has been fun. I will say, having gone through, uh, become an accountant to CPA, gone through all of that process, all of the jobs that I've had in the area, it has made it. It has given me an opportunity to see a lot of things that a lot of people don't maybe get the opportunity to see, like like how banks really work. What's the process there? How do they really make their money? A lot of people don't, because they don't understand all that or don't get involved or haven't been exposed to it. They don't really fully understand sometimes how banks make their money, and frankly, some bankers don't understand how they make their money. It's amazing sometimes that I'll run into bankers that think that they can run a bank by doing nothing but investing in bonds or something. You've got to take risk as a banker. Banks make money by evaluating risk, credit risk, interest rate risk. And interest rate risk is basically inflation risk. That's what they get paid for. So if they don't take any of that risk, they don't get paid anything. So you can uh, you could run a bank and not make any money if you just don't take any risks. But so like I said, a lot of times bankers don't even understand that. You'll see bankers sometimes, that'll move to uh, a situation where they view it as being more riskless, and and in reality, that they're not making any money. So do you take risk and then at least have the possibility of a reward, or do you not take risk and you're going to lose money? That's kind of the concept there sometimes. So it's been interesting. I mean, that process, that banking industry thing, a lot of times you're dealing with clients that are developing projects, or they're running their business and they have certain business issues that maybe are cutting edge. Maybe people haven't really experienced it before, and you're trying to figure out what to do from a financial standpoint. So it's been an interesting process, and so some of that I like to share here on this show. You can also call in 220-9788. That's 220-WSTU if you have a question or want to make a comment, because uh, I think that some of the best economists, published economists that I know, were not necessarily economists by education. They became economists over a period of time by studying the science and getting involved in it. That's the other thing I kind of wanted to make a comment on, or a point on this morning before we get started, is that we're going to talk about economics, and economics is a science. It is something that, if that you can have a hypothesis, and that you can test that hypothesis. Sometimes that's over a long period of time, and sometimes it takes generations to run your experiment, to figure out what the outcomes are going to be, and it's very hard to sometimes test economic principles, because you don't have a control group. You can't, sometimes you don't have a group that is taking a position and one that's not taking a position, so you can evaluate both. So sometimes you don't have a control group. Sometimes there's a lot of extraneous variables that could cause you to come to the wrong conclusion if you're not focused on, specifically where the result is and how it is. because many times in economics, the initial result isn't the final result. It isn't what your outcome is going to be. It may be what in the short run, it may be some sort of an effect in the short run, but in the long run, that effect is going to go away. So so it's an interesting science. Whereas finance, to a large degree, I consider finance to be an art. It is about where the numbers go and how they go, and how you can increase things in the short run potentially, or how you can make some money for somebody, how you can uh, invest, or how you can utilize your resources to produce a return that's better than somebody else's. In that situation, it's not a science. You can't always do the same thing every time and get the same result. There's other things that come into play that affect that. So anyway, so that's kind of what we're dealing with or talking about a little bit. Just kind of a general discussion of some of these principles and some of the things that are happening. And I know a lot of people. It's not that they don't, that they're not up on economics from the standpoint of they don't understand it. It's that they've not been exposed to it. So you come up with some misconceptions because again, you see the short term effect, but don't see the long term effect. So uh, let's talk about one item: taxes. This is one I'm always on about, because you'll constantly hear people say that corporations don't pay enough tax, and and um, and they'll say, so we really need to tax corporations. Well, first of all, corporations can't pay tax. And it's funny, but people say, "What do you mean?" Well, taxes for a corporation. So let's talk a publicly traded company. That corporation, it has costs and then return on investment. All right. So on a publicly traded company, it has material costs, it has labor costs, it may have technology costs, um, and it may have a if there is a tax, a corporate tax, it may have a tax cost, right? And then the remainder is return on investment. So, what happens if I increase any of those? What happens if I uh, and I'm getting to why corporations can't and don't pay taxes. So, if I get an increase in taxes, say I now have to pay, there's now a corporate minimum tax and I have to pay a tax. So now my tax cost has gone up. So now what's going to happen? Well, if I don't do anything, my return on investment is going to go down, right? And you're saying, well, that's what we want. Rich people that own, are people who own all of this, and average people who own it all through their IRA, through a mutual fund of some kind. So first of all, let's burst the bubble that stock owners are wealthy people. They are not. They're primarily retired people uh, that have money, or people who are preparing for retirement. So if we reduce their return to a level below what they need, we're just going to end up supplementing that return in their retirement through higher Social Security or some other thing that we're going to have to do to get them money in retirement. And so, but so in that situation, the investor is, first of all, not who you think it is. And second of all, even as an investor, if my return goes down, I let's say I own Apple, and my return goes down on Apple. Well, I'm going to sell it. I'm going to sell it and probably buy, Motorola or Google, something else. Same type of business, but that isn't. In fact, you know what? I might buy something out of I might buy something out of China. I might buy something out of Europe. Maybe I won't even buy something that's a U.S. company. Maybe the company is located offshore, and I'll buy so I won't have to pay any taxes at all. Um, so, so from a practical standpoint, if you reduce the return to the investors, they will leave. If they leave and they take their capital with them, your company goes under because it doesn't have any money to run. That's the capital is what a business is run off of. So if all of a sudden all of the stockholders, if you can't sell the stock because everybody wants out and nobody wants in, then you have a situation where that company will collapse. It can't sustain itself. Um, and will eventually go under. Its borrowing costs will go up. Everything will go up. It'll have to shift from capital to borrowing, which will then have interest costs. So it'll have other costs that it has to assume, um, and it will replace its return on capital with an interest expense. So so it's important to understand that if I if I increase any one of those expenses, so what am I going to do? You increase my taxes. Well, the first thing I'm going to do is potentially try to reduce my materials costs. So I'm going to try to buy less expensive materials. Can you say cheap? Can you say China? So you want to know why companies invest in products out of China? Because if they're cheaper, it allows them to either make more money or offset their any additional costs that they have. So that's the first thing. I'm going to look to probably buy cheaper materials. Um, the second thing I'm going to do is look to uh, to reduce my salaries costs, my benefits costs. So I'm going to get rid of people. So it's going to cause unemployment. So now again, in the first scenario, um, I if I reduce the return to investors, I lose my company. Then the company goes down. So that's not a choice. If I uh, if I buy cheaper materials, I then put U.S. manufacturers. I've cost them jobs because their sales have now gone down, and they have to find a way to replace those sales. And they probably can't reduce their price because their labor costs are too high relative to China's. So they can't compete. Any product that frankly involves labor, China is going to be cheaper. India is going to be cheaper. Pakistan is going to be cheaper. Anything that involves labor, those countries are going to beat us on that. So if you have a product that primarily is labor driven, they're going to win. And so that's what's going to happen. So if this stuff moves offshore, we lose U.S. jobs, which typically pay higher. So now we've created unemployment. If we have if in the business that gets taxed, if they can't reduce their material costs, maybe they've already reduced their material costs. From an economic standpoint, they would have, because economically, if companies have competition, if it's a fair market and a free market, so to speak, then there are equal powers on both sides of the equation. They're equal sellers. They use the term equal sellers, equal buyers, but really what it means is there are equal powers on both sides of the equation, so that the price becomes a market negotiated price, because nobody has the upper hand. And then you reach what's called equilibrium, which is the fair price. So if you're already in that kind of a market, you're probably already reduced your material costs to the level that they are, you've already reduced your labor costs. So at this point, um, you've already done all of those things. So now, what are you going to do? Well, you can try to reduce your tax costs by moving offshore and have keeping your profits offshore and not paying tax on that, finding a way to keep it all into Ireland, where you can treat it all as royalties or intellectual property fees, and then that's not taxable in Ireland, so that's all tax-free income. And as long as you don't bring that back to the United States, you don't have to pay tax on it. So you can leave all that money offshore because your company can be offshore. And some of your facilities will be offshore, which again costs you U.S. jobs potentially. Um, and we lose control. Frankly, the more these companies become international, the less control we have over them. Remember during the war, there was a great deal of patriotism on the part of corporations. Now, part of it was selfish because they were generating, they were generating money by selling to the military. The Ford automobile dealers, those kind of people, they were converting production lines and selling equipment, producing equipment for the war. So they were making money. So some of it was, but part of it was patriotic too. These were all people who lived in the United States. They all believed in our system. They all believed in democracy, and we were under siege. So everybody pitched in, uh, and tried to do what they could do. But as companies have become international, they have no loyalty to the United States. Why should they have any loyalty? Why should they do what we want them to do? If it does not make economic sense for them, why would we do what the U.S. government tells them to do? You wouldn't. If you're international, if you've got international leadership, and many, many of these major corporations do, if you have international leadership, if a large portion of your market is not in the United States, uh, you're not going to have that loyalty to the U.S. We tend to think in the past. We tend to think, oh, this is a company, this is a U.S. company, so why would they do that? Why would they sell this to our competitors? Why would they give this technology to China? Why would they do whatever? Well, they're not loyal to the United States. They're not. They are loyalty to their stockholders. Yes, maybe their stockholders are in the United States, but in many cases, their stockholders are international as well, and they're large funds from large international banks. So you've got to look at some of that now and see what's changed. But so I've increased the taxes. I've reduced my materials cost potentially, but that didn't work because I've already got as low as I can. I'm now going to try to reduce my labor. Okay, so I'm going to go to my employees and say to them, by the way, taxes went up, so all of you are taking a 5% cut in pay or a 15% cut in pay because it's a 15%. We're all going to take a 15% cut in pay. How's that going to work out for us? Well, it's not. So, that's not an option. But what is an option? Well, I can replace them with technology. Now, I may not have done that up to this point because it didn't make sense for me. In other words, the cost of implementing that technology, even though it's a one-time cost, the cost of implementing that technology wasn't going to be recovered. I didn't have any way to cover my costs in making that conversion. But now I do. I've got a justification for it because I've got this tax I've got to pay. So if I can avoid that tax by implementing artificial intelligence, which I don't have to pay wages to, I don't have to pay payroll taxes to, I've eliminated all of those kind of things, then then do I just do I go ahead and just make that change? And at that point, it does make sense because now my costs long term, my payroll costs, my employment costs, my training costs, all of those things have gone away. Now, years ago, there was discussions about technology and that technology would not does not cost jobs, and in that period, in that time, I think that that's probably true. Um, and I think today the difference is the technology is more artificial intelligence. In the day that when the equipment came in, it actually created higher paying jobs and jobs because people had to know how to run the equipment. They had to know how to use it. They had to, make sure that somebody was monitoring it, knew what was going on with it. So it needed supervision. The equipment didn't run on its own. It needed somebody to. Now, you may be able to run six pieces of equipment at the same time, whereas before you were, maybe doing one, or you could only do one task. So it made sense, but you still had to have the people. But what happened is it substantially increased productivity because it allowed you to produce more product with the same level of labor cost. So therefore, it really didn't cost jobs. Uh, but now I'm not so sure in today's environment that that is going to be the same. I mean, in the long run, if the artificial intelligence job is replacing a job and doesn't need supervision. I mean, if it's uh, truly artificial intelligence and it does exactly what the person did without any review or supervision, uh, it's not at that point probably going to increase productivity. What it's going to do, though, is reduce cost. So, in technology in the past produced productivity increases, which then offset. So you didn't need a cost overall. You were more productive, produced more product with the same costs. Therefore, you had a cheaper product. And assuming that the market would buy your product, you you didn't need to reduce costs because you just increased the number of product of widgets you could produce with the same level of cost. So I'm not sure artificial intelligence is the same thing there. And so I'm throwing artificial intelligence as a separate item because I think artificial intelligence, true artificial intelligence that's out there right now, reduces labor and does eliminate labor jobs and replaces them with artificial intelligence jobs doing the same exact thing. So we haven't created any productivity increase, which is what the original technology changes did. The original technology created higher productivity. This is not a productivity change. So it will eliminate jobs. So the tax increase, I'm not gonna reduce pay to my employees because they're not going to buy that. They will quit. But what I'm going to do is replace them with things that can't quit. I'm going to replace them with technology that is artificial intelligence. Does exactly the same thing, doesn't do more, doesn't do less. It just does the same thing. But I have a one time cost that I'm now able to spread out over years and years instead of annual multiple costs that also have other tax costs with them, like payroll taxes and Social Security taxes, and all kinds of other benefit costs like health insurance. I don't have to provide health insurance to my artificial intelligence. So so that's so when you look at this now, these are my choices. So if I can't, if I'm stuck, if I have tax, I can't not shift that. So now my first choice on all of this, my first choice is I would increase the cost of my product. If I'm going to pass that tax cost on to the consumer of my product, the consumer of my product is going to pay the tax. How are they paying the tax? Absolutely, they're paying the tax in the form of an increased price, inflation. Inflation is taxes. Inflation is corporate tax passed on to the consumer in a market where there's not adequate competition. And let me repeat that because that's really an important concept. A free market, it revolves around coming to equilibrium. It is only a free market that will produce a fair price if there are equal sellers and buyers, equal strength sellers and buyers. If one side of the equation is stronger than the other, you don't have a free market. So you can't let it go. You can't say, well, this is a free market, we're not going to regulate it. Yes, you do have to regulate it. Certain industries that have become so successful that they have no competition, you cannot leave them unfettered. Yes, that's a great thing. They made money, they did things, and that's fantastic. But we have to recognize that at this point in time, that company is going to become a predator because they can. They're going to do not what the market wants them to do. They do what they want to do because they can. There's no competition. Who are you going to go to? Nobody. There's nobody else out there. That's not a free market. That's not a free price. That's not producing the maximum product that benefits the economy. It absolutely doesn't. It's producing the absolute product that benefits the person that owns that company or the people that own that company or the company itself and its shareholders, right? It produces an unfair profit because the profit is not at equilibrium. There's more money that's going to be paid than should be paid because that company is more powerful. Do you think if there was a free market, if there were equal buyers and sellers, we would be buying Apple iPhones at $1,100 a piece, $1,200 a piece, more than a full computer? You think we would be doing that? No. But there's no competition for Apple because Apple has created a market where technology-wise and mentally, everybody has to have an iPhone. They don't know how to use an Android phone. They don't want to use an Android phone. They want to have an iPhone. When you go to that point where you have tons of people that want to buy the product and only one company, Apple, that produces an iPhone, they can charge whatever they want. And they do within reason. They know that they don't want to, that they don't want to. There's a there's a certain point where if the price gets so high, the volume will go down that they'll actually make less money. So, it's kind of a balancing act to come up with that price where it won't completely shut off demand because people have to have phones. But at some point in time, if you get to the point that, um, you raise the price too much, you you can force people out of the product. They just can't afford it. Or you have the government coming in and subsidizing phones, and they're not wanting to pay the full price, and that kind of thing. Now we got the government involved. The government's involved. They're big enough to compete. Well, maybe not with Apple, but with most companies. There's a few out there that are bigger than them, but most companies the U.S. government can compete with. Maybe don't want to, but so that's why it's important to understand what's going on, in this thing. So what would happen normally is if you increase corporate taxes. Now I'm talking corporate taxes here, and I'm making a distinction from taxes on small business, which are primarily pass-through entities, partnerships, LLCs, taxes, partnerships, S corps. And those are what they call pass-through entities, which means that the individuals pay the tax, not the corporations. So in that point in time, that is being passed directly on to the owner. Because those companies generally are not publicly traded, those pass-through entities, they don't have the choice that the corporate investors do. The corporate investors move to another stock. They sell Apple or sell whatever and move on to somebody else. But these other companies, these large, uh, independently owned companies or closely held companies, they can't make that move. They can't do that because they don't have that option. I mean, as an individual, they can't necessarily move their family to Ireland. It just isn't working for them. Now they can maybe set up subsidiaries outside the country and do things like that, but they don't have as many choices, because they're location driven. Many of them, they're market driven, and that market is a local market of some kind. It might be a local county market, state market, might be a local national market, but it's at least a local. They're not a large independent international company. Most of them are local businesses. But in that situation, they may not have the choice, although they'll go out of business at some point because they can't pay the taxes, and they uh, will shut down. If they're in a market where they don't have competition, they will increase their price. So what happens in general with an increase in taxes is you end up with, like I say, you end up with uh, either a reduction in labor, so you end up with unemployment, or you end up with inflation because the product's price goes up and is higher. So when you see somebody increase their price, most likely that's because they are or have are experiencing an increase in costs that they can't pass along, that they can't absorb, or that they don't have to absorb, and that and then they're passing that along as a higher price. In most markets, you can't do that. If you raise your price, you just don't sell anything. The only way that works is if universally everybody in your market, everybody that produces iPhones gets a tax increase. Um, Everybody that produces a widget gets a tax increase. And if they all get the same tax increase, then uh, then they might be able to all simultaneously increase their price. But there will be some. That whole process takes a long time to work through the system, and some people are estimating what's going to happen. We've seen price increases right now in anticipation of higher taxes, of anticipation of inflation on material costs. Again, inflation on their material costs has to be passed on. The the more the more regulated and limited the product is in terms of restriction on its sale or tax on its use or whatever, the the higher the inflation is going to be for that product. It just makes sense. The more cost they have to bear, the more they're going to have to increase their price. So that's why in certain industries that are petroleum based, because we've seen a shortage in petroleum available, or anticipated shortages. Some of this is just anticipated, but because those are there, a business can't wait until it happens. They've got to start making their moves in advance. You know, uh, like for example, there's been a lot of criticism of the meat industry. Think about what the time frame for meat is. You just don't have a cow. You just don't all of a sudden have this fully grown animal that you then butcher up and sell it for its meat. You don't. You have years of raising that cattle, losing some of them, having to feed them, having to feed them correctly, having to have places to put them. And wait a minute, for a rancher, hasn't the land cost gone up? Isn't land more expensive now? What do they think? Where do you think that goes? They say, well, that's not why. Why should meat be more expensive? Well, if I've got 800 head of cattle and I got to put them someplace, I got to rent some land to do that. So that land cost is factored in to the price of my meat. I have to get more for my meat because my land costs are up. So, all of these things, there's a lot of petroleum costs involved in raising cattle. There's a lot of feed costs and other things that have to be done. So, and then there's a lot of there's a lot of risk. You know, you don't you may start out with 800 with 800 head of various ages, you don't necessarily end up with 800 head. Now, if you lose a calf, that's maybe not as big a deal because that you've only got a year into, maybe two. But if I lose, if I lose a uh, uh, fully grown heifer or fully grown, whatever, um, then I lose. That's costing me a lot of money. I have a lot of years in. I may have a few years in that. Um, if I lost a bull, I might have a lot of money in that. So anyway, all of this stuff is why we now have inflation. So what I'm getting at is what we've got is not a temporary thing. When a cost goes up, whatever that cost is, when that cost goes up and that cost is something that is not able to be adjusted, you are not looking at a temporary price increase. That's taxes or labor costs being pushed through the system. So at this point, uh, what's happening in large is we've had an increase in salaries, we've had an increase in wages, partly because of negotiation, because of inflation, uh, partly though just because you can't get workers. So people are paying higher prices, they're paying premiums, they're paying overtime to get people to work. That cost has to be passed on. Um, and then at the same time, corporate taxes are looking at going up. So what's happening is we're having a permanent in many places a permanent increase in the cost of production. Permanent increases end up getting passed on because a large portion of the industries, particularly or the companies, particularly large publicly traded companies, don't have competition. I mean, when you think about it, there's a handful of companies out there that are in the pharma industry. There are a handful of companies that are in the technology business that are out there. So you don't have competition. They can universally increase prices. They can limit service. They can do whatever they want to do. They cannot provide certain services. They can charge you extra for certain services. They can do all of those things. That's inflation. And that's inflation that's come from the economy. That's due to some sort of economic uh, stimulus. It can be, like I say, taxes or anticipated taxes. It can be as a result of inflation in their own material costs. It can be a result of inflation in their labor costs. Any of those things that are temporary um, are that could go away, that are temporary, are not going to may not potentially result in long term inflation. But the increases that we've just experienced are not temporary because they're in labor. As soon as they convert to labor costs, um, you don't reduce labor costs. You might get the next administration to reduce taxes, which might then offset some of those labor costs. But right now, uh, you've got permanent increases in things that are going to drive up the cost of the products. And that's only fair. Labor has to get more money because the cost of products have gone up. Here's the sad thing about inflation. It's the worst tax because it always stays ahead of the consumer's increase in spending. Your labor costs, my labor fees, are never going to go up as fast as inflation. We never keep up with inflation because we always lag everybody lags a little because they don't want to raise their prices and lose their business if the inflation is temporary. So we all absorb some of that and lose some money, don't make as much money. We absorb some of that cost. And then when we realize that, you know, this isn't this isn't going to go away in a month or two, we then start increasing our prices. And then once we've done that, then we will then start increasing our price. But you know, by then inflation is 10% and we've increased our prices 7% after the fact. So we're already 3 months behind, and 3% behind where the market's actually going. So now we've got we keep lagging. We keep lagging because we keep not wanting to be increasing prices if prices are going down or leveling off. So, we keep going, and then the market does, it stops, and we are underneath it, and we kind of lag it going. We try to lag it going down, but you don't, because going down, it comes down fast. Because as soon as your competition cuts price, you got to cut price. So there's no obligation to raise price once your competition's raised prices. So it's a delayed impact. So once inflation gets into labor in a business environment, you're going to be looking at that inflation becoming permanent for some extended period of time. Um, it's it's just going to happen. As opposed to, say, for example, if it affects interest on debt, affects your borrowing costs, that doesn't become as permanent because it can move up and down, and the cost moves up and down. The unfortunate thing is that as those costs go up, a lot of times on that type of expense, the business can't pass it through or increase it. That's why they're borrowing money, and it usually results in a loss of jobs because the business goes out of business. Can't pay the interest anymore. So if the interest rate goes up to 15, 18% on prime, there'll be a lot of businesses that will go out of business because they can't afford that cost any longer. They can't afford to pay 15%. So, and I think, we've seen that happen before. So don't be surprised if it happens again. Uh, we the other thing that's interesting about inflation is, again, inflation is the worst kind of tax because it is a tax that's typically pushed through. That's usually what causes inflation, because if it's not a tax that everybody has to pay, then inflation would then it then the price isn't going to be able to go up because not everybody's going to raise their price. So if I don't have to pay that cost because I'm not, I'm not subject to that cost for whatever reason, then I'm not going to raise my price because I don't need to. I'm still making good money, or I'll just raise my price a little bit. I don't need to raise it 8%. I'll raise it 4%, and I'm making money because my cost hasn't gone up. So so some of that is whether or not it's uniform, and that's the trouble with taxes, is that they pretty much apply to everybody. So um, in terms of who has to face paying it. So at that point, usually it's taxes that cause that inflation. That inflation becomes part of becomes part of prices, other prices in the economy, and it significantly increases it. Now, I talked briefly about interest rates. So the other big factor here is that interest rates are historically low. They're still historically low. They can move quickly and will move quickly as soon as the market senses that we're looking at some extended inflation, because inflation eats up your return on bonds. You're just, if inflation is 10% and your bond yield is 4%, you're not living off of that. You're gonna have to do something because that's gonna cost you a lot of money. And nobody wants your bond because your bond pays 4%. So you're going to have to sell that bond at a discount, which means a loss for you, uh, at to get rid of that bond. So the bond market hasn't fully absorbed and is kind of blindly. I refer to it as the Powell effect. He sat there for a year and said, "Well, this is temporary. This is temporary. This is transitory. We're going to when they got rid of transitory. It's amazing how they got rid of transitory. They just said you can't use that word anymore. That's pretty good. But he sat there along with Yellen and said we don't really have inflation. This is temporary. This is temporary. What has he said in the last 30 days, 60 days? This isn't temporary, isn't transitory. We're going to have to start raising interest rates. Well, interest rates will increase before he raises them. What people are waiting for is to see how much the Fed raises and where they go with this next meeting. But pretty much everybody's starting to abandon the process and start abandoning bonds anyway, which means that the government, which owns a bunch of its own bonds, which is kind of stupid, when they start selling those bonds, they're not going to get their money back. They're not going to get paid back as much because those bonds are now going to be cheaper when they sell them back. So we're looking at that. And the way you can tell that is recently there are treasury bonds that are called TIPS. They're Treasury Inflation Protected Securities is what they stand for, which means that their yield is tied to inflation, not to the interest rate. And so their yield is tied to inflation. Those bonds just recently have outperformed, have been more popular than all of the other bonds. So that kind of tells us where we're at with that. So keep an eye on inflation because, first of all, inflation is a huge tax and it's the worst tax. But keep an eye on inflation because it's here to stay. And the next place we're going to see it is in mortgage rates. And that's going to have a big impact on our local market here if mortgage rates go up 4 or 5 or 6%. So if you've been sitting on the fence thinking about refinancing, this is the last time I think you're going to see historically low rates. But anyway, thanks for joining us here on Treasure Coast Solutions, here every Wednesday from 9 to 10 o'clock, right here on WSTU Digital 1450, Martin County's Heritage Station.